Today I'm going to go over what I've been doing since the coronavirus started and what I've been doing especially over the last couple weeks since the stock market has really decreased recently. So I started a new Roth portfolio. I hadn't finished my contributions for 2019 yet, and I've been shoveling some cash in there. So I'll show you it here, and then I'll go through each holding that I have and kind of my thought process behind how I'm investing and when, and then the actual holdings that I have within the portfolio. So the numbers are a little bit weird. They're not rounded because I've been doing weekly contributions at one point and then stopped it, so it left off at a weird number. So what I did was I originally opened this up with the minimum of $500 that's required for this investing platform. They have free trades, and I like how they set everything up, and I think it's pretty intuitive for the most part, so I wanted to go with M1. I want to invest in individual stocks. Up until this point though, I hadn't ever invested in individual stocks really, because I knew that the market generally, the general market, like the index funds that hold stocks in 500 different companies, they generally do better than people that pick individual portfolios. They're a lot more diversified and a little bit safer too. But I realized that in times like this, when there's something that's such a black swan event that people didn't foresee it coming, there's some stocks that are very unprofitable in the short term, but then once they get back to normal, then they do quite well again, and you can get them for a huge discount at this time because a lot of people won't invest in them. So that's kind of what I tried to do. I tried to pick up some bargains. I tried to get some of the stocks that were really on sale, and then some that are just long-term plays that didn't really make sense back a month ago when they were trading for 20% more. So I started the portfolio with $500. On Monday, I think it was, the market went down by 7%. The Dow dropped about 2,000 points. I invested another $1,500 that day. And then today, the market's down another 3.5%. And I invested another $240 today to round out my numbers for the year. So I invested $2,240. Looks like the value is about $113 less than that. This isn't quite right because I rebalanced the portfolio. So some of it sold and bought other stock that was also decreased. So that accounted for another $5 or something. So I'm just going to go through each holding, kind of my thought process behind it. And even though the market has gone down and I've lost $100, I feel really good about this because I'm going to continue to buy, and I can average down my position, and I know the stocks I'm getting are good quality stocks that are going to do well. So I'm just going to go through this. These are the holdings. So first one, just a Vanguard S&P 500. So let's see if I can make this wider. No. So what I have on here is 25% of the portfolio is going to be in the Vanguard S&P 500. So it's by far my largest position. What I'm doing with this is, I know that this is supposed to be individual stocks, but I want something that weighted down my portfolio so that way it was a little less risky. I diversified a good amount in that 25%, so that will stop it hopefully from fluctuating too much compared to if I didn't have it. So I know that the S&P 500 is still down about 15% from what it was a month ago, so I picked 25% up. I think it's a good way to start off the portfolio, and for me, just having something more diversified helps. The next largest holding I have is Berkshire Hathaway, and I am having 12% of my total investment in Berkshire Hathaway. If you don't know anything about Berkshire, they are the company that Warren Buffett runs. He has some other people in the company with him too, but what they are is a massive conglomerate. So they hold positions in Apple, and Heinz, and JP Morgan, and Delta Airlines, and a hundred other huge companies, and they have billions of dollars in each of them. They also own some companies completely outright, from bricklaying companies to Duracell to Geico. They own a lot of stuff that you see. They sell homes, they do everything. So they own maybe 50 to 100 companies outright, and then they own massive positions in some of these other big companies. For example, they own 5% of Apple as a company. So what they basically do is they can move money from one investment to another, and they have a lot of synergy because they have so many relationships in so many different places. Another thing that's really attractive about them to me is that they have $125 billion in cash. So basically a fourth of their company is just cash right now. Now, a lot of people haven't really liked Berkshire over the last 10 years just because they've been sitting on so much cash that their returns have been lower than just a general stock market index fund. But what Warren Buffett tends to do is wait for a deal. So he won't just throw money at some stock because he thinks they will go up. He likes value investing. So if he can guarantee money for his stockholders, he will go out and give it to someone. So like in 2008, when the banks were failing, I think it was Goldman Sachs. He contacted Goldman Sachs, or they contacted him, and he got a 10% guaranteed dividend on what he lent them. He did that with a couple other banks too. I think one bank he lent $3 billion, and they guaranteed a 10% dividend, and then he could also claim 10% at any time. So he got $300 million a year in interest, and then could get another $300 million at one point along the loan. So, I mean, he can guarantee some big wins if the stock market goes down, because he has so much money to deploy that his company is a good hedge against a down stock market. So that's kind of what I'm thinking there. That's why I have 12%. It's my second largest position. If the stock market tanks, they can take advantage of some of those cheap deals in the meantime. Then when the rest of the stock goes up again, he will have gotten some great deals. So the next thing that I'm holding is Vanguard Real Estate. So this is a real estate REIT, or they hold REITs. It's a fund that holds companies that have a lot of real estate. So these real estate companies typically give out a large amount in dividends, and then this is just a company or a fund that holds a bunch of those companies that will give out lots of dividends. So they've been pretty steady. I could click on it here and show you it. Over the last couple years, they've done quite well. So they have a low expense ratio. You don't have to pay much to be in them. Over the last 1 month, they went from about $100 down to $82 today. And over the 3 months before that, they were steadily going up. They pay a good dividend. I don't know if this will show me it here, but I can look it up here. I think they pay right around 3 to 4%. Yep, so they pay 4.3% today because of the stock market going down. They pay a little bit more. So what I'm using this is just to diversify into the real estate market. Try to get some exposure into something else. So I think it will be another good hedge against down stock market. And it's something that will provide constant cash flow. I think that they will continue to get better returns over time, and I'll be able to use that money to fund all my other stock purchases. So They're just a play where it's diversified. It will pay me a good amount, and I'll just be able to use that to buy more of everything else. The next stock I have is Delta Airlines. So 10% of my portfolio is in Delta. I'll show you why I did that, but they have one of the stronger balance sheets as far as these companies go for air travel. So another reason I like them, that's not it. They are an industry that will come back right after the coronavirus is gone. So yeah, they might be down for a couple months afterwards, after this kind of rolls over, because people might not be comfortable traveling yet. But after companies can start sending their people again, these airlines will start making more money. And if you look, they've gone down about 30%, and they were just rolling in money. So their price to earnings ratio is below 6. So they were earning, I don't know, $16 to $17 on, or percent on their stock. And then they have a dividend of 3.83. Maybe they'll cut it because they're not making much money right now. But I think their payout ratio was below 20 or something like that. Let's see. Yeah, so it was right around 20. And they've been growing their dividend consecutively for about 6 years. So they're giving out almost 4%, and they only had to pay out 20% of their earnings. So I think that they can quickly get back to the dividend if they cut it. And then they'll continue to try to grow it to gain confidence from their investors again. So I think that it's a great value. I think they'll go pretty far back up after this is all blown over. It's a good sign too that Warren Buffett invested in it. I think so, at least. So I think it's a good play. I think it's something that's necessary for our economy. People aren't going to start taking trains across the ocean, so we'll have to get back to using airplanes. The next stock is maybe a little bit riskier. It's Carnival Cruise Lines. So with Carnival Cruise Lines, a lot of people haven't been wanting to touch them, but I have invested in them heavily for my portfolio. It's 8%. I think that they're a good company. I think maybe the cruise lines will take a little bit longer to come back because people don't want to be quarantined for a week on vacation after this whole thing, compared to just like in an airplane, which is necessary to get around. But Carnival Cruise Lines, I think, has a good future. They pay a really good dividend right now, which I think they'll be able to recover just like Delta. But the thing with these cruise lines is their downside risk is kind of capped out, because I don't believe that they're going to go bankrupt. If they go bankrupt, the banks will lose a lot of money. So these corporations have to build now billion-dollar ships. Carnival, I think, has between 20 and 30. I think they have about 25 or 26 of these billion-dollar ships. So if one of them goes bankrupt, the bank will get their boats, and then they have to sell them to one of the other 2 or 3 major competitors, which won't be making any money either at that point. So they won't be able to do anything with these ships, essentially. As opposed to if one of these cruise lines goes on hard times, they are going to reach out to the banks probably and just ask for a larger line of credit. I think Carnival or Royal Cruise Lines reached out and got another $500 million line of credit just a few days ago. So these banks would rather get the free loan interest or not free, but the loan interest from these corporations and let them go bankrupt. Especially because if the banks take a hit, the executives are the ones that are going to lose their jobs from it. So they're going to make these things go through. I think that it's a good company. I think it has a bright future. They have one of the best balance sheets and have more cash than the other major cruise lines. So I think that they will come back pretty well. And if you look at their stock price, I think it's gone down more significantly than any of the other ones I've shown. But I think it's gone down maybe 60% over the last month. So I'll pull it up here. Maybe I won't. Let's see. Okay, so yeah, it was right around 50. It's about 22 now, so it's gone down 58 to 60% over the last couple months, or last month, I guess. Next one is IIPR. I just added this. I hadn't really looked at them in a while. I had gotten them actually as a free stock a while ago for a bonus from a different brokerage, but I looked at them again. They are a company that buys real estate from dispensaries. So the dispensary maybe owns the real estate. IIPR will come in and buy the real estate from them and then lease it back to them. So they have been expanding like crazy. I think they've been around maybe 3 or 4 years, and their sales have consistently expanded, and they've been increasing their dividends like crazy too. But they've been growing between 200 and 2,000% a year in sales. So I think they're a good play. They also yield 4 to 4.5%, which is really high for how much money they're making right now. That's unsustainable at that yield, but they're earning so much more each year that that they can afford to do that in the short term, and then hopefully become profitable soon. So I have a larger percentage of my investments in them, and I added them recently. I have Foot Locker here too at 5%. I put money in them. They make a lot of money. If you've never looked at them, their PE ratio is really low. Again, price to earnings ratio, not FL Locker, but Foot Locker stock. They own Foot Locker, they own East Bay. They have a really good online presence for selling shoes, selling equipment. Foot Locker does a lot of their sales online. And then East Bay, if you don't know what East Bay is, they are a very large company that sells pretty much everything that you would want for athletics. They're not name brand stuff a lot of the time. They sell some name brand stuff, but they have their own brand also. But their stock has been down quite heavily over the last month. If you look at them 1 month, I think this is still the last 5 days. Yeah, for some reason it's not showing. It's down significantly, and they pay a good dividend yield, P ratio under 6. So they make a lot of money, and they have been going down significantly recently. Another one, JP Morgan Chase. They are 5% of my portfolio. They are just one of the largest banks, and I think they are the largest bank in America. They have a good dividend yield. They are pretty safe. The Fed cut rates recently, and most likely will cut rates again, as I understand. So that kind of hurts the banking industry because the spread on how much they make off their loans decreases. But I think that buying JP Morgan Chase now, right after the cut happened, you're getting a discount because eventually the US will have to raise rates again. Maybe it's in a few years, but they need to be able to cut them. And at this point, they can't cut them much more unless they go negative. they can cut them 1 or 2 more times before that happens, but they have to raise them up again, and then JP Morgan Chase will be a great way to capitalize on that. And they also pay a good dividend, so that's another one that I'll use to kind of fund the rest of my portfolio. I have NRZ here, which it's a mortgage REIT, so they invest in mortgages. I don't know too much about how mortgage REITs work, what they do. I believe that they buy and sell them or something like that. I'll be honest, I don't know too much, but they pay out a good dividend. They have to pay out a significant amount of their profit. So unlike some of these other companies that can reinvest in themselves and pay out, between 0 and 100% or 0, and a lot of the time they only pay 40 to 50% of their profits out in dividends, NRZ pays out a ton. They pay 90+%. So the dividend yield for NRZ right now is about 12%, and actually now that's down 10% today. It might be up to 13 or 14%. So they are the main company, the biggest company in here that will fund all the other companies' growth. The next one, Royal Caribbean Cruises. So I picked up this one. Looks like I picked it up a few days early, but I mean, I've only lost $20 on it so far. I think they're another one of these cruise lines that won't go out. They're too big, and they've been down so much. I think they are the company that's been down 75 to 80% of their stock price from a month ago. So I think that they'll come back too, just because they're almost too big to fail. No one wants to take that loss, and they'll be able to come back from that. It just might be a year or two. I have Comerica stock, which this stock has taken a big beating too. They are down about 40 to 50%. They are a regional bank out of Michigan, and I have a small percent, just 2% now, and the target percentage is just 1%. They just are a high dividend yield stock, so I put them in there. Amazon makes very little profit now, as I understand, as a company, but they have their hand in so many things. Their streaming service is huge. Their shipping and just their e-commerce business is huge. People buy stuff from Amazon every day, and right now they've been doing so much reinvestment in the business that they haven't become as profitable as they can be, just because they're expanding like crazy. So I think in a few years, and they're already one of the biggest companies in the US, if not the biggest at the time of this video, that they will be able to turn that dial and stop reinvesting so much, and then maybe start paying out dividends or just giving more money back to stockholders. Facebook, I recently increased my position. It will take effect when I put new deposits in, from 2% to 7%. Facebook owns Instagram and Facebook Messenger. They're positioned to be one of the best companies to take advantage of the online advertising space. So they make most of their money from Facebook ads, but what I see is a lot of people moving and using Instagram a lot more, and they haven't really capitalized on Instagram at all. If you go into Instagram, there are very few ads, and they can monetize it more like YouTube monetizes, where they roll ads before the video and after the video and during the video. They can do that on stories and monetize a lot more, and just a lot more people are going to be putting money into online advertising over the next few years, because people my age don't watch commercials on TV. Either we don't watch TV at all, or we just pull out our phone and mute the TV or something when it's on ads. So I am investing heavily in them, and they've gone down significantly over the last couple weeks. And then Disney stock. I think Disney is a good play too. They are expanding. Their streaming service seems like it's doing real well so far, and I think they're a very family-friendly company that has their hands in lots of different things, from products to now streaming. to parks and lots of other stuff, films, shows. So I think that they're going to be another company that does quite well. So this is kind of what I've been thinking over the last couple weeks. I also had some other funds that I put in, just general stock market index funds, more like this stock. But I want to be able to capitalize on some of these good deals, I think, and build something that has a little bit more, it pays higher dividends, this portfolio does, than my other funds do. So if you like this kind of stuff, let me know. I'll probably be changing this up a little bit as time goes on. I'm still trying to figure out exactly what all the allocations that I want for these. And it's hard to tell exactly how I want to do it, but this is what I've been thinking so far. If you like this stuff, please let me know below. If you have any questions, or you want to tell me what you're doing during this coronavirus outbreak, that'd be great. I'd be happy to hear about it, and I'll see you in the next video. See ya.